In June of 2022, I started a YouTube portfolio challenge to see if I could invest money and beat the S&P 500. Since then, I have been tracking every buy and sell in the portfolio and sharing the process and the returns with the YouTube channel. This is a way for me to share my investments and thinking with you and use it as an opportunity for us to learn together. I cover both the good and the bad, the successes and the losses, so you can learn from it all. As a reminder though, the YouTube portfolio is a paper portfolio. I am not a millionaire, so this is just a test and an opportunity for all of us to learn together. However, I do personally own the stocks within the YouTube portfolio, and in some cases, my personal allocations are even higher than in this portfolio. So you could almost say that I am being even more conservative on the YouTube channel than I am being in real life. Anyways, this is a way to track my investing and show you how I personally invest. The number one question I get is the YouTube portfolio outperforming the S&P 500? So let's take a look. At the time of recording, since inception, my portfolio is up 32% versus the S&P 500's 20.3%, which is a net outperformance of 11.5%. Year to date, my portfolio is up 28% versus the S&P 500's 19.5%, which is an outperformance of 8.5% so far this year. Now let's take a look at the moves I have made since the last update, which was quite some time ago now. There are four major changes that we need to discuss. The first one is the sale of Berkshire and the purchase of Brookfield and Topicus with the proceeds. The second is the sale of PDD and the purchase of Brookfield Infrastructure with those proceeds. The third is the sale of True North Commercial and the buy of Topicus with those proceeds. And the fourth and final sale is the one of TD Bank and the purchase of CP Rail with those proceeds. So let's start from the beginning with the sale of Berkshire. I sold Berkshire at a 30% gain and used the money to add to my Brookfield Corporation and Topicus positions. I have discussed Brookfield at length on my YouTube channel and dedicated entire videos to explaining why I believe this stock is undervalued. So what I will say here is that I believe Brookfield is offering higher future potential returns than Berkshire at both of their respective prices today. I actually believe Berkshire is more on the expensive end, and here's why. Berkshire's price to free cash flow is sitting near all-time highs of 29.5 right now, which is also well above its historical averages of 21.3. A price to free cash flow of 29.5 is equivalent to a free cash flow yield of 3.4%. Which is not a super attractive yield on the shares today. Brookfield, on the other hand, is trading for a free cash flow yield of 9% when you use the company's distributable earnings metric. This means Brookfield is offering higher yields than Berkshire today, and Brookfield is projecting to grow its cash flows by 20% annually over the next 5 years. Topicus is also selling for a free cash flow yield of 4.5% today, which is higher than Berkshire's free cash flow yield. Additionally, Topicus has been growing its free cash flows at 18% annually, and I believe the business will be able to continue these levels of growth in the future. So what it comes down to is, I think all three of these businesses are incredibly high quality, but Brookfield and Topicus are simply trading at lower prices and growing more quickly. Due to this, I believe these stocks will produce higher returns in the next few years relative to their prices today. And for that reason, I have chosen to sell Berkshire at its high price and place the money into what I believe are better opportunities. Now let's move on to the next sale, which is PDD for Brookfield Infrastructure. I sold PDD at a profit of 68.8% and used the money to buy BIP instead on October 27th. The reason behind this move is that BIP was selling off like crazy. There was a ton of negativity surrounding this business, and a short report even came out against the company, which accused it of falsifying its financial statements and suggesting its dividend was not covered by its cash flows. I made a video here on my channel going through the short report against BIP and why I believed it was false. I also believed that the stock was looking very cheap due to all of the fear surrounding it, so I knew I wanted to add it to the portfolio. Therefore, a stock had to be sold for me to be able to buy Brookfield Infrastructure, and PDD is the stock that I decided to sell. So far, this has worked out well, with Brookfield Infrastructure up 26.7% from the time I bought it. But now, moving on to the third move in the portfolio. This one is the sale of True North Commercial Real Estate. This one did not work out for me at all, and resulted in a 52% loss on the position. I bought TNT because I thought the stock looked very, very cheap. Back in March, TNT announced that it was cutting its dividend, as the business wanted to put more of its money towards paying off debt instead. I thought that this was actually a smart move on the management, but the stock dropped a whopping 44% after it announced this. It continued to sell off, and it got to the point where I thought it was looking too cheap to ignore. So I started a position at $2.75 in the YouTube portfolio. At the time, even after the dividend cut, the stock was still offering a 13% dividend yield. I thought the business would be able to continue paying this dividend as well, and I thought that I could collect a 13% yield on the shares while I waited for the stock to recover. However, the stock ended up continuing to fall. It also recently reported its third quarter results and announced a total cut to the dividend, so the stock no longer pays one. And after going through the numbers, it looked to me like the business's cash flows deteriorated significantly, more than I thought they would, which led to the business no longer being able to cover its dividend with organic profits. In the third quarter, the company raised $40 million by selling off assets, and used $27 million to pay off the mortgages on the buildings that it sold. This means it raised a net of $13 million from asset sales. They also did $16.6 million in operating cash flow, then paid $3.6 million in capex, which means they did $13 million in free cash flow. $13 million in free cash flow plus $13 million net from asset sales is $26 million of total liquidity on the quarter. The money then went to $6.8 million to paying dividends, $8.3 million to finance costs, which is interest, $5.8 million to principal repayments, and $4.4 million to paying off their credit facility. This is a total of $25.3 million spent on the above. The important numbers are the principal and interest payments of $14.1 million, because when you compare this to the free cash flow of $13 million, it means the business's free cash flows are no longer covering its debt repayments. The additional $13 million in asset sales is where the extra money came from, and the asset sales are also how the company was able to pay its dividend in the last quarter. Therefore, it looked to me like the business could no longer afford to pay its dividend or cover its debt load with its organic cash flows. And ultimately, my initial thesis on the stock proved to be wrong, and led me to sell and take the loss on the position. However, I always knew that TNT was a higher risk investment, so I made it a very small position in the overall portfolio. Even though it lost 52%, the total loss to the portfolio was about 1%, which sucks, but it is not the end of the world. The lesson I learned here was that dividend traps are real, and businesses' cash flows can deteriorate very quickly. So I need to be more careful in the future and really think before buying a stock just for its 13% yield, even if I do believe its cash flows can currently cover it. Now, the one thing that I did do well here is I made TNT a very small position in the portfolio, so even though the stock was a failure, it did not damage the portfolio all that much. The proceeds from TNT went to buying Topicus to increase my position in that business as well. But alright, let's now move on to the fourth and final trade in the portfolio that we have to discuss. This one is the sale of TD Bank for a 8.7% gain and the purchase of CP Rail with the proceeds. I think TD Bank is a great long-term dividend stock, and I initially purchased it because I believed it was undervalued and offered a nice dividend of over 5% at the time. However, the goal of this portfolio is to beat the S&P 500, which means it needs to be focused on finding the best opportunities and investing in the best stocks. If we head over to Stock Unlock's discounted cash flow calculator, we can see that if TD's earnings grow by its historical average of 4.9% annually, then the stock could produce 5.2% annual returns. The dividend is about 4.6% right now, so that means TD could yield a total of 9.8% annually over the next 5 years. On the other hand, based on CP's own projections of over 10% annual earnings growth over the next 5 years, I believe it could generate close to 15% annual returns. Therefore, I believe CP could produce better returns than TD, and that is the reason why I have swapped it out in the portfolio. I also made a full video on why I think CP could produce strong returns over the next 5 years, and what my entire investment thesis behind it is. So if you are interested in hearing my full thesis and analysis, then make sure to go and check out that video as well. Again, I do still think that TD is a great long-term stock. I just think that CP better suits the YouTube portfolio's goal of beating the S&P 500. Now, one thing that I do want to address is in the previous portfolio updates, I have been accused of overtrading, which I do think is a totally fair accusation. I am a long-term investor, but I am also quite active in my portfolio, so I want to explain why. To beat the S&P 500, I always want to have the best risk-reward opportunities in my portfolio. And the thing is that both risk and reward constantly change with the price of a stock. For example, in my DCF calculation of CP, we can see its future estimated stock price would be $144 per share. Now, based on its share price today of $89, this means that it could deliver a compounded annual growth rate of 14.8% over the next 5 years. However, if CP were $120 today, then its annual returns would only be 3.6%. This also means that if CP shot up to $120 next week, then I would be selling it. Why? Because as the price of a stock rises, its future returns go down. And when I am trying to maximize returns, then I am always paying attention to the current price of the business versus what I expect its value to be in the future. Therefore, if a business's stock trades above what I believe its fair value is, and gets to a point where I do not believe it will offer strong returns in the future, then I will sell it. For me, there is a price where every stock is a sell, and I personally do not believe that every stock should be held onto forever, regardless of what its price does. For example, if Brookfield's stock 10x tomorrow, then I would sell it. Why? Because at that price, its future returns would probably be incredibly low. So even though Brookfield is my largest position, and I think the stock will produce strong returns over the next 5 years, if it gave me all of those returns tomorrow, then I would sell it because the future returns afterwards would most likely be low. I understand that this may not suit everyone, but as an enterprising investor, I cannot ignore the valuations of the businesses I own. And I do believe that I should always be investing where I think the best rewards are. And again, as prices change, so do the risks and rewards associated with every single investment. If Berkshire were half of its price right now, then I would be adding to it instead of selling it. So I adapt to the circumstances in the market and I place my money where I believe it is best allocated. Now, on that subject, it's only fair to take a look at how this investment strategy has worked out for me so far. So I went through every single trade that I have made in this portfolio to see whether or not it would have been more profitable to simply hold on to the stock and not sell it. What I mean by this is that every time I sell a stock, I immediately use the cash to buy another one that I think is offering a better opportunity and selling for a better price. So what I did is looked at the stock I sold, its share price I sold at, then its returns since I sold versus the returns of the stock I bought instead. It basically compares whether I would have made more money by simply holding onto the stock rather than swapping it for another one. So here's a screenshot of all of the trades that I have done, and you can see that 14 out of 16 have been profitable. Or in other words, in 14 out of 16 cases, I have made more money by selling the stock and swapping it with another one. When I cut my Google position to buy Lumen is a good example. I sold half my Google at $121 to buy Lumen at $17. Since then, Lumen is up 41% and Google is up 12%. Therefore, I have made more money by selling Google and buying Lumen instead. The two times where the sells did not work out are both with Meta. I sold Meta at $205 and $240, and I would have made more returns by holding on to that one instead of selling it. So I am not perfect by any means, but the track record so far says that the buying and selling activity that I have done has in fact produced more returns. Now, I don't know if this will continue in the future or if it is the best investment strategy. All I know is that it is the one that I am most comfortable with and the one that makes the most sense to me. So all we can do is see how this continues to play out over the longer term. Lastly, here is the allocation of the YouTube portfolio now. There are 16 stocks and basically 0% cash. It is totally invested, and you can see all of the allocations on the screen here for yourself. I also use Stock Unlock's portfolio tracker to track all of my portfolios and do all of my stock analysis and research. Stock Unlock is an absolutely incredible platform for tracking your stocks and doing investment analysis. And right now, Stock Unlock does have a 30% off Black Friday deal. So if you are interested in checking out Stock Unlock or you want to get that 30% off discount, then all you need to do is use the code BF30 at checkout, and then you will apply that 30% off discount. So if you are interested in Stock Unlock, then do not wait and go and get that 30% off discount because it is not going to last forever. But that is going to wrap up the video, everyone. And if you did enjoy this video, then please remember to leave a like on it and subscribe to the channel if you are new here. Thank you again so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next video.